Welcome to InvestorHubX.com. The Death Cross and Golden Cross are two of the most well-known signals in trading. They are often used to identify major trend changes in the market. But here's the problem. Most traders misunderstand what these signals actually mean. They assume these crosses can predict the future. But in reality, both the Death Cross and Golden Cross are lagging indicators, and by the time they appear, the market has often already made a significant move. So in this video, we'll break down what is a Death Cross, what is a Golden Cross, the difference between what traders think and what actually happens, a deeper understanding of the Death Cross, and how traders should use these signals in real markets. Let's begin. Let's start with the Death Cross. The Death Cross is one of the most well-known indicators in trading. It happens when the 50-day moving average crosses below the 200-day moving average. The 50-day moving average represents short-term price trend. The 200-day moving average represents long-term trend. When the short-term trend falls below the long-term trend, it signals that momentum has shifted to the downside. The Death Cross is not just a technical signal. It represents a shift in market control. It means buyers are losing strength, rallies are becoming weaker, sellers are gradually taking over. The market is transitioning from bullish to bearish. The Golden Cross is also one of the most well-known indicators in trading. It happens when the 50-day moving average crosses above the 200-day moving average. When the short-term trend rises above the long-term trend, it signals that momentum is shifting to the upside. The Golden Cross represents a shift in market control. It means buyers are gaining strength, pullbacks are getting bought, sellers are losing control. The market is transitioning from bearish to bullish. In reality, most traders look at the Death Cross and Golden Cross in a very simple way. They think a Death Cross means market will crash, and a Golden Cross means market will rally. They think a Death Cross marks the start of a bear market. The Golden Cross marks the start of a bull market, and the crossover itself is the signal to enter trades. In other words, people believe these crosses can predict the future. In reality, Death Cross confirms the market has already been weakening. Golden Cross confirms the market has already been strengthening. These signals are lagging indicators. They are based on past price data. So by the time they appear, in some cases, key word is in some cases, a significant portion of the move has often already happened. There are two common scenarios when a Death Cross appears. Let's break them down. Case 1, the late signal. By the time the Death Cross forms, the market has already dropped significantly. You're not early. You're actually late. This signal often appears near the bottom of the move. Price starts to stabilize, and sometimes it even begins to reverse. If you short here, you're entering too late, and when the market rebounds, you can get trapped. Case 2. Trend continuation. Now, in this scenario, the market is already in a strong downtrend. The Death Cross appears, and it confirms that weakness. But instead of reversing, price continues to fall. If you ignore this signal, you're fighting the trend, and there could be much more downside ahead. Here's the real problem. If you treat the Death Cross like a crystal ball, you expect it to predict what happens next. But the reality is, sometimes you enter, and the market goes up. Sometimes you wait, and the market keeps dropping. You simply don't know which case it is. One of the safest ways to use the Death Cross and Golden Cross is not to trade them directly, but to use them together as confirmation tools. Step 1. Death Cross appears. When a trader sees a Death Cross on the daily time frame, it signals that the market is currently weak and there may still be further downside. Instead of entering immediately, the trader waits. Step 2. Wait for strength. He waits for a golden cross to appear. This suggests that momentum has shifted back to the upside, buyers are regaining control, the market is likely transitioning into a bullish phase. So, why this approach works? This method avoids catching a falling knife. It reduces exposure to further downside. It confirms trend reversal before entering. It prioritizes safety over early entry. However, there is a cost. The trader will miss part of the move. This approach sacrifices early profits in exchange for higher confirmation and lower risk. To summarize, today we've learned what a death cross and a golden cross are. We explored what most traders think these signals mean and what actually happens in reality. We now understand that a death cross is not always the beginning of a bear market. In some cases, it may even appear when the bottom is already close. And most importantly, we've learned how professional traders use the death cross and golden cross together, not to predict the future, but to increase the probability of their trades. Because in trading, it's not about being early, it's about being right with confirmation. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.